Hi everybody, Brian Matthey from Verico the Mortgage Professionals in Kingston, Ontario. Happy New Year! This is 2013 and the first of my video series on Mortgage Straight Talk. In my first video of 2013, I'm going to be talking about 2012. And the reason I'm going to be talking about 2012 because it's a continuing story of what happened in 2012 and how that can impact you in 2013. So, in today's video, we're going to talk about the story of 2012, how it impacted interest rates, and what it means to you. So let's start off with 2012. First of all, in 2012, at the beginning of 2012, the Bank of Canada expected we were going to be into an economic recovery situation. They felt we were going to see interest rates start to rise in the first half of 2012. All eyes were on Europe and the US looking for that economic recovery that was going to impact Canada as well. It didn't happen. There was no economic recovery, and bad news is good news for interest rates. The Canadian government focused on consumer debt. The government couldn't raise prime because if they did raise prime, it would impact interest rates, it would impact our economy. So the government was on hold with interest rates. But the government turned around and used regulation to impact the housing market, to slow down consumer credit. So let's talk about what the impact of all of that was on you. Again, going back to the first half of the year, we saw that the first half of the year interest rate was flat, and lo and behold, the last part of the year, the Bank of Canada rate was flat again at 3%. So for all of you who are in variables, who are enjoying substantial discounts or perhaps paying your variables at a higher rate of payment, you're making great strides and you're in a great place. Probably at least for the first half of this year, and in fact maybe even to the latter half, based on what the Bank of Canada said in December. Fixed rates. Again, bad news is good news because it impacts bond rates, keeps interest rates down. And what happened? We saw rate wars, and we saw 5-year rates 2.99 and below, 10-year rates 3.89, in some cases 3.79. And for those of you who were renewing or refinancing or first-time buyers, it was a boon because you were able to finance and lock in your rate, and many people took advantage of 10-year rates to secure the lowest rate in history and secure their payment. Government regulation in the middle of the year, around June, the new B20 guidelines came in and started to creep into lenders, and lenders said we're going to adopt them before we have to. And the have-to date was November 1st when they came into effect. And what did that mean? Well, for first-time buyers can't borrow as much as they did before because amortizations changed. The second thing was it was more difficult to qualify. There were a whole new range of guidelines relative to not only first-time buyers but existing mortgage clients, where we have to look at a whole new different set of guidelines that are more stringent than they were before. For self-employed people, we used to be able to do no income qualifiers or declared income qualifiers. That's gone the way of the dodo. Now it's more proof of income. Now there still are some lenders who will lend in that area, but it is much more difficult for self-employed borrowers to borrow than it was before. Lines of credit that traditionally were used by people for investment properties or for using it to replace high interest rate debt with lower interest rate debt, the government restricted lines of credit to 65% of value instead of 80%. Posted rates. Now, when we do a mortgage, unless you choose a 5-year or above, or if you choose a variable or less than a 5-year, we're required to use a much higher rate, can be 1%, 2%, 3% higher than the current regular rate to qualify you. Again, means less mortgage qualification. Refinance, that was a big change. We used to have 95%, then 90%, then 85%. The government came this year and said no longer, it's 80% max. So now you can only refinance up to 80% of the value of the property. That has impacted a lot of borrowers because before, borrowers were able to organize their mortgage and their debt into a much nicer package. They're restricted now at 80%. And the last thing was rental properties. Again, rental properties in the past, the guidelines were a little more fluid. They are much tighter than they are today, so they're making borrowing for rental properties much more difficult. That's a synopsis of 2012, where we are in 2013. My next video, I'm going to be talking about variable rate mortgages. If you're in a variable rate mortgage right now, you'll want to watch this video. I'm going to be talking about what you should be looking at if your mortgage is coming due for renewal, or what you should be looking at is now the time to convert. I'm going to be talking about fixed rate mortgages. For those of you, again, who are coming up for renewal, may have had a fixed rate in the past. Do you take fixed? What are the pros and cons? And finally, my third video, won't be my final video, but my next video in the series this year, will be talking about mortgage strategy. And for those of you that don't have one, I am going to show you some fantastic ways. In fact, I've been run off my feet this year with a lot of my clients, showing them strategies how to increase their equity, make a better financial position for themselves, not the lender. That's it for Mortgage Straight Talk. Hope you liked it. If you liked today's video, please like it on my Facebook Mortgage Straight Talk page. Thanks for watching. Talk to you soon.